Hello everyone. Today we will continue talking about the combinations. If you remember in the previous chapter we were talking about the theoretical part by identifying the different types of combinations like merger and consolidation, and we try to discuss the different reasons for combinations and the benefits the company might get and so on. So today we will talk about the accounting work in the area of combinations from the investor sides and how the investor is going to recognize the purchase of the shares and the dividends, revenue, and so on. So the investor will start recording the different transactions based on the percentage of his ownership. So for example, if the shareholder or the investor is buying less than 20% of the shares of the subsidiary, he should use the fair value of the shares and use the cost method. If the investor is buying between 20 and 50% of the shares of a subsidiary company, then he used the equity method. And we will discuss these two methods in details in this chapter. But if the investor is buying more than 50% of a subsidiary company, he should use consolidated financial statements, and we will discuss this topic in the coming chapters. So now let us look briefly on how to do the journal entry under cost method and equity method. First of all, we say if the shareholder or the investor is buying less than 20% of the subsidiary company, he should use the fair value of the shares during the date of purchase and recognize the dividends he receives from the subsidiary as dividends income that should be recognized under current income. But if the investor is buying more than 20% and less than 50%, he should use the original cost of the shares adjusted to reflect periodic earnings and dividends. So, in this case, the shareholder should buy significant amount of shares, as I said, between 20 and 50. And he should have influence on the subsidiary company. There is some indicators to show the inability of the shareholders to exert influence on the subsidiary company. For example, if the shareholder has opposition by the investee that it challenges the investor's influence, or surrender of significant stockholders' right by agreement between investor and investee, or concentration of majority ownership among the other shareholders, or inadequate and untimely information to apply the equity method, or failure to obtain representation in the board of directors. In these examples, the shareholder cannot reflect the equity method in his book even if he has significant amount of shares. So to apply the equity method, the shareholder should have significant amount of shares and significant influence on the subsidiary. Now let us look at the journal entries under the fair value method and the equity method. So for the fair value, we assume a company, Bob, buys 2,000 shares of Sun for $50,000. And he doesn't have significant influence on Sun. In this case, we record as investment in Sun for $50,000 and we credit cash for $50,000 to reflect the purchase of the shares. And when Bob received dividends, as we see here, $4,000, he will debit cash and credit dividends income. And in this case, the dividend income will go under revenue in the income statement. But we assume at the end of the year, Bob reduced the dividend income recognized, maybe because the cumulative dividends exceed the cumulative share of income by 500. In this case, we debit dividend income and we credit investment in Sun. And if some changes happen to the share price at the end of the year, we debit allowance to adjust available for sale security to market value, and we credit unrealized gain on available for security. And this is the way we record the purchase of the shares, the recognition of the dividends, the reduction in the dividend income, and the reduction of the increase in the fair value of the share. But how can we record the same transactions if we apply the equity method? So, the first journal would be almost the same, where we debit investment in Sun, we credit cash. But the second journal, we used to say debit cash, credit dividends income. Here we say debit cash, credit investment in Sun, which is the same account we use it in the previous transaction. And then when we determine the income, we debit investment in Sun and we credit income from Sun. So what is the key difference between the fair value method and the equity method? In fair value method, we use several accounts, but in equity method, we use one account, which is investment in subsidiary company.